Okay, people are joining in. Before I start, a very quick announcement. I know that if you're going to turn in your DCF feedback, I'd given you Friday as the deadline. I'm going to extend that to Sunday for a simple reason. I really have family commitments this weekend, so I really can't grade that many valuations over the weekend anyway, so I might as well give you the extra 2 days. So if you can't get it in by Friday and you want the weekend to kind of finish it, that's perfectly okay. So try to get it in by Sunday, and I'll try to get it back to you as soon as I can. Any questions on that DCF or any of the logistics? Okay, so let's make sure I'm recording here. Yeah. So today we're going to complete the process of intrinsic value. Jake, you have a question?
You have a quick question about unlevering betas. So
Yeah.
with banks or financial services with high
Don't
debt, is it worth? Don't do it. Okay.
It's not even worth. It's not a question of worth it. You can't even define debt to equity ratios for banks. So you really let it go, right? Because debt to a bank is raw material. It's not a source of capital. So you just use the levered beta of other banks and you move on.
Okay, thank you.
In fact, today we're going to value banks, and this one of the things I'm going to talk about is how to come up with the cost of equity for a bank, and you're going to see this play out. So let's start with the start of the class test that we usually do. And today's, since we're going to talk about banks today, might as well start with that as the first question. Right? So let's say you're valuing a bank, and you're valuing a bank. It's conservatively capitalized. What does that mean? Well, it's got a very high regulatory capital ratio, much higher than what they're required to maintain. So it's got more capital than needed. Knowing nothing else about the bank, if you were looking at this bank's fundamentals, I want you to tell me what combination of the following you're most likely to find, given that it's overcapitalized. First, high return on equity, low risk. Second, low return on equity, low risk. Third, high return on equity, high risk. And fourth, low return on equity, high risk. So let's break that down. First, in terms of return on equity, if you're overcapitalized, would you expect to see a high return on equity or a low return on equity?
I would say low.
And the reason is?
Because you're holding more equity that you could be investing into profitable engagement.
So basically, you've tied up more equity in the company, so you're going to have a low return equity, right? In terms of risk, do you expect this company to be lower risk, or the bank to be lower risk or higher risk than a typical bank, given that it's overcapitalized? And the biggest risk banks face is if regulatory capital constraints kick in, then bad things happen to you as a bank. Because they're overcapitalized, that's less likely to happen. Doesn't mean it's not likely to happen, but it's less likely. So overcapitalized banks will tend to have low return on equity and low risk. The reason I say that is often when people look at banks, one of the dimensions they look at banks on is return on equity. Banks with high return on equity are considered to be good investments to make. Already I'm adding a catch to that, right? Because if you look at banks with the highest returns on equity, they tend to be banks that are walking really close to the edge in terms of regulatory capital ratios. When times are good, you don't notice, but all you need is a shock and you wake up and say, oh my God, what did I do here? Banks remain among value investors' favorites because they pay high dividends. Okay, so you look for banks, you look for high dividend yields. The cautionary note I'm adding is if you're going to screen for cheap banks, in addition to screening for dividend yields, you should probably also screen for regulatory capital ratios, which in S&P Capital IQ, you can actually check to see what banks have both high dividends and high regulatory capital ratios. Raja?
Yeah, I was going to say that A seems like a bit of a utopian scenario, right? Like we'd like to have risk.
But remember, that's why we screen. So here's how you'd go to Capital IQ and screen. You'd first screen for banks. Then you'd screen for banks with returns on equity more than 20%. So let's say you find 100 banks. Then you run a screen for, among these banks, give me the ones which have tier 1 capital ratios that exceed 20%, which is a huge number for a bank. Maybe 11 will come through. These are banks which have high return on equity and have high regulatory capital ratios. Doesn't mean you go buy all 11, but now you can focus your attention on those 11 and say, hey, is there a reason why they look so good? Maybe there's something else I'm missing here. Maybe they have hidden losses that haven't shown up. But when you screen across large universes, you're looking for that utopian combination. You're right, it's unlikely, but there's no harm looking. Now, I'm going to ask you a follow-up question. Many of you are done with the value. Rodrigo, are you done with the evaluation?
Almost. I have a value for a subsidiary.
Okay. So what do you get as your value? Just give me a
I
rough
got
number.
8 reais in Brazilian
8
reais.
reais. What's the price?
It's 9.10.
That's not going to work for me. But let's say it's 4. Let's make it a scenario. You valued it at 8. The price is 4. And you feel really, 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 really confident about your value. In fact, you feel it's almost certain to be the right value. Don't ask me how you got to that point, but let's say you feel certain about the value. So price is 4, your value is 8. Can you put all your money in that one?
I can, but I wouldn't.
Why? If you feel certain about the value, what's holding you back? What are you uncertain about?
I'm uncertain about some assumptions, maybe.
No, but remember, I said assume that you feel so certain about your assumptions that the
Okay.
$8 becomes almost a fact.
Yeah, then the market would have to converge, and that might
So-
take a...
And that's exactly the problem, right? Even if you feel certain about your value, you cannot feel certain that the price will adjust to the value. Now, a few weeks ago, I sent you a quote from Charlie Munger. And the quote said, anybody who holds more than 3 to 5 stocks is crazy. Charlie is 97. You got to cut him a little slack. He's lost all censoring mechanisms. He says whatever's on his mind. But he clearly believes that concentration is the way to go. Mark Cuban says the same thing. He says, don't hold more than 3 or 4 stocks. And it's these are big names pushing this notion that concentration is good. And they say, look, if you do your homework, and this is what the old value investors say, if you do your homework, what are you so concerned about? You've done your homework. These 3 to 5 stocks come in as undervalued. So what are you worried about? And my answer is, I can do all of my homework, but I don't control the market. I might believe GameStop is overvalued, but guess what? It doesn't matter. The forces driving GameStop have nothing to do with me, and I don't control them. So today we're going to talk about what to do about that gap, because you have a gap between value and price. To act, you have to think about what will happen to that gap, and we're going to talk about that gap. So let's go back to where we left off last session. And I think we were on page 313, maybe. Let's see, 313. No, we were further back. 341, I think. Yeah, 341. Let's go to valuing financial service companies. So ready? Just sit down to value a bank. What are the 4 questions? What are your cash flows? What's the value of growth? How risky are you? When will you be a mature company? Let's try answering this for a typical bank. When I say, what are the cash flows at a bank? You're going to be stymied, and here's how. Here's why. To get the cash flows for a company, what do you need to do? You need to start with earnings. You add back depreciation. You subtract CapEx. You subtract change in working capital, right? Try doing that for a bank. The earnings are going to be easy to get. That's net income, because you're doing everything from an equity standpoint. If you look for depreciation at a bank, you're going to find hardly any depreciation. If you look at CapEx for a bank, you might as well completely give up. There will be no CapEx in the statement of cash flows. They don't build land, equipment, factories. And what's working capital for a bank? It's everything or it's nothing. Getting cash flows for a bank is almost impossible to do. So you know what? Most people give up. We'll talk about what they used instead, what I used instead until 2008. But getting to the cash flow is so difficult, people just throw up their hands. When I ask you, what's the value of growth? If you don't define what capital expenditure is, how can I even tell you whether it's value creating or value destroying? Because you can't nail down those basics, estimating the value of growth at a bank becomes almost as difficult. When I ask you, how risky is this bank? You're going to very quickly run into a problem. Finding the information on the riskiness of a bank is almost impossible to do. You read through the annual report and you try to find out what percentage of their loans are bad loans. They don't give you that information. And with the bank, when I ask, when will this bank become a mature bank? The question I'm asking is not whether the bank will go out of business, because banks almost never go out of business. They just get taken over by the regulatory authorities and passed on to another bank. I'm at the mercy of the regulatory action that might be taken against my bank. Banks remain perhaps the most different sector in the market when it comes to valuation. So I'll make a confession. In all of my valuation books until 2008, I had a chapter on valuing banks. And every one of those chapters started with a statement that I'm still trying to live down. You know what my starting statement was? Valuing banks is easy. And then I proceed to tell why. And that statement was based on two assumptions. The first was the assumption that banks were run by sensible people. And the second was the assumption that the regulatory overlay actually worked, because banks are regulated, that regulatory overlay would keep them from doing crazy things. Let's see how this plays out. I'm going to show you a traditional bank valuation. This is how I used to value banks, and we'll talk about why this is the approach that most people used to value banks. It's a bank called CIB. It's an Egyptian bank, and I'm going to do the valuation in Egyptian pounds. So that's going to create a little bit of distortion because you're not used to seeing things in pounds, but it's not that big a deal. It's a different currency. So CIB is a well-regarded Egyptian bank, and it's hard to value them based on dividends. You know why I'm looking at dividends? If I cannot estimate cash flows, I get desperate. So give me the dividends. And in the year leading into this valuation, now CIB had paid dividends of about £1 per share, which is about 25% of their earnings. So in the most recent year, they made £4 in earnings, paid out £1 in dividends. Here's what I'm going to do. I'm going to try to forecast the dividends I will receive from investing in CIB. To forecast dividends, what's the first thing I need to do? I need to forecast earnings. And I'm going to draw on that fundamental growth equation. If I know that you're retaining 75% of your earnings and earning a return on equity of 42%, that's a mind-bogglingly high number, right? But remember, it's in Egyptian pounds. I get an expected growth rate of 32% a year. If they keep doing what they're doing, their earnings will grow 32% a year. For the next 5 years, that becomes my growth rate. That gives me earnings per share. They pay out 25% of those earnings as dividends. I get dividends per share. After year 5, what happens? I think the growth is going to start to come down. It's going to start to come down from 32% down all the way down to 10%. And as the growth comes down, to be consistent, my payout ratio will go up. Why? Because if I don't need as much money to retain, I can pay it out. So my payout ratio, which is 25% for the first 5 years, climbs to 60% by year 10. So two things are happening. My growth in earnings starts fast and then slows down. My payout stays low early, but then picks up. My expected dividends come out of those two numbers. Dividends are cash flows to equity. So I discount them back at a cost of equity. A little messier than usual because I'm building an Egyptian pound valuation. So I needed a risk-free rate in Egyptian pounds. Now remember, normally the way we estimate risk-free rates is we start with the government bond rate and you do that little kabuki dance of default spreads. I can't do that here because the Egyptian government doesn't have long-term bonds. So I use the cheating way, which is you start with the dollar risk-free rate and you adjust for differential inflation. The risk-free rate in Egyptian pounds is 10.153%. Now do you see why I can get away with the 10% growth forever? If your risk-free rate is 10.53%, there's high inflation and I can build it into my growth rate. But the bottom line is with that risk-free rate and this huge risk premium, because I get 100% of the business in Egypt, my cost of equity is 23%. Discount the dividends back at the cost of equity. The value per share that I get for CIB is $42 per share. It's an old-fashioned dividend discount model with bells and whistles added, allowing the payout ratio to change and the growth rate to change, but it's built entirely around dividends. And the reason is simple. It's difficult to get cash flows. In fact, it's impossible. And because it's impossible, we throw up our hands and say, hey, you know what? We're going to use dividends. The last time I used a dividend discount model to value a US bank was actually in 2008. It was actually on October 7th of 2008, just as we were going into that crisis. And I valued Wells Fargo. And I valued it looking at the numbers as they existed then. So if you look at them, they were paying out about 55% of their earnings as dividend. Banks are among the biggest dividend payers in the market. They were paying big dividends. I was giving them a growth rate of about 6% a year, reflecting the fact that we were now in a crisis. But again, I still stuck with dividends because I said, what else can I do? I can't estimate cash flows. I have to use dividends, and I'm going to discount them back at the cost of equity. I know some of you are valuing banks. My suggestion is you start your bank valuation with the traditional dividend discount model, but don't stop there. And here's why. Remember those two assumptions I said I made before 2008? That banks were run by sensible people and that the regulatory overlay actually worked. You see why I need to make those assumptions? When I discount dividends, what am I implicitly assuming? That managers at banks pay out what they can afford to pay out. Right? That requires sensible management. When I discount those dividends at a cost of equity, remember I just used a levered beta. This is actually one of the first questions. Do you adjust the beta? No, I use the levered beta. I'm not differentiating across banks. What am I saying? I'm saying there are really no really risky banks and really safe banks. You know why? Because the regulatory authorities make sure you stay within the bounds. If I assume that banks are run by sensible people and that the regulatory overlay works, I can use the dividend discount model. And until 2008, I did. What happened in 2008? We had a crisis. And it was a crisis centered around what sector? Banks. Badly behaved banks. And the first thing we learned was that regulators were not doing their job. So there goes my trust in regulators keeping banks within bounds. And then in the quarters after, here's what we saw banks continue to do. One of the worst crises in the last century for banks. The regulatory capital has been damaged. They're all in trouble. And if you're a sensible banker, what should you do about dividends if you're in serious trouble and you have regulatory capital constraints? You should stop paying dividends, right? But you know what banks continue to do? They continue to pay dividends even as their regulatory capital is melting down. There goes my second assumption. Banks are run by sensible people. I woke up in 2008 realizing I could no longer trust banks to pay out what they could afford to and just discount those dividends back at a cost of equity, because if I did that, I was going to get hammered by banks that did not behave well. Nick, you have a question?
Yes, Professor. My question is for example, how would you explain the 19% fall in Credit Suisse because of the recent thing, and how would you explain use this model to explain that huge fall?
Well, the huge fall is going to turn out to be a big loss for Credit Suisse, because remember, as the bank are backing these up, if you can't come up with enough money, you got to make up the difference. That comes directly out of your net income and dividends. Whether it's enough to explain away the 19%, we don't know yet, because we don't know how big the problem is. They're being incredibly opaque about exactly how many billions of dollars of shares they still need to sell. So at the moment, people are guessing that this will create damage. Maybe they're overestimating it. But from an earnings and dividends perspective, it'll mean lower earnings. And eventually those lower earnings will translate into lower dividends. But I'm going to give you a much more direct way of bringing the problem in. Because as long as you stay with dividends, it's a bludgeon, right? You don't really get much finesse there. So we're going to talk about how do we bring in the fact that banks can get into trouble, that they have big losses. Where does it show up? With the traditional dividend discount model, it's actually tough to find a pathway. And that's part of the reason I'm going to devise a second way of valuing banks.
Thank you, Professor.
So I said the reason we use dividends is because we don't have CapEx, depreciation, working capital. So in 2008, I started thinking about, hey, I don't trust dividends. But if I don't trust dividends, I need something to discount. I need a free cash flow equity. And I said, I can't compute free cash flow equity for a bank the same way I do it for other companies, because CapEx, depreciation, working capital doesn't make sense. So I reoriented my thinking. I said, okay, what does a bank have to invest in to be able to grow and survive? The answer is actually very simple. For a bank to grow and survive, it's got to have enough regulatory capital. What does that mean? There are these definitions of what banks need to maintain as capital. It includes book equity, preferred stock, etc. But there's a certain amount of tier one capital, and they have these tier one, tier two, tier three. There's regulatory capital you have to maintain. You say, what happens if I don't maintain the capital? The regulatory authorities can actually shut you down. So if you're a growing bank, you actually have to increase your regulatory capital to reflect the fact that you have more loans outstanding, you become bigger. If you have a bank in trouble, like Credit Suisse, you're writing off something from your regulatory capital, you now have to come up with fresh regulatory capital to make up that difference. Trust me, this is going somewhere. To me, the equivalent of CapEx at a bank is what the bank has to invest in regulatory capital to grow and survive. You see what I'm already telling you, right? If you're a growing bank, you need to reinvest more than if you're a mature bank. If you're a troubled bank, you have to reinvest more than if you're a healthy bank. If you're a bank that's had a recent big loss, you have to reinvest more than if you're a bank without that problem. So my definition of free cash flow equity is to start with net income. This is what you always start with. But instead of adding depreciation, subtracting CapEx, subtracting change in working capital, I'm going to subtract out the reinvestment they will have to make in regulatory capital. I know it sounds incredibly abstract. So I'm going to take you through a valuation I did a few years ago, almost 5 years ago. It's a valuation I did of Deutsche Bank. In fact, the blog post I wrote to back up this valuation was titled "A Greek Tragedy at a German Bank." And I picked those words intentionally. You know how the Greeks like to always pick on, I'm sorry, the Germans like to pick on the Greeks as being this, no, they're very undisciplined. They don't know what to do. They can't run a bank. And here you have the ultimate German institution. When you think Germany, you think Deutsche Bank, having all of the problems they accuse the Greeks of having, right? Being completely undisciplined. In fact, Deutsche Bank in 2016 reminded me of one of those characters you see in a horror movie. You know, one of those really bad horror movies, usually it comes around Halloween. It's usually a teenager who does stupid things repeatedly, like what? Go into a dark basement where there are no lights over and over and over. You know this is not going to end well, but he or she keeps doing it over and over and over again. Deutsche Bank was like that teenager. Every year they'd be, Deutsche Bank would find a new dark basement to go into. And he said, please don't go down there. And they'd come back all bloodied and cut up and said, never again, no, 1 year later, they're back again. So to give you some perspective, Deutsche was hurt like every other bank by 2008. 2008 hurt every bank. If you look at 2009, JP Morgan, Wells Fargo, everybody reported losses. But here's the difference. Deutsche reported a loss in 2009, but they reported a loss in 2010. They kept losing money for whatever reason, the residual effects. So every year they'd find a new crisis and a new problem, a new write-off. Every time you lose money, it comes out of your regulatory capital. So year after year, the regulatory capital ratio kept slipping. So they went from being one of the best capitalized banks in Europe to, by the middle of 2016, one of the worst capitalized. And then came a death blow. The US Justice Department fined them $10 billion for something they did in 2008. You're saying, what does a fine do? Where does the fine come out of? It comes out of your regulatory capital. You put that fine in, that tier 1 capital ratio dropped to 12.42%. You're saying, what does that even mean? One of the things you can pull off S&P Capital IQ is tier 1 capital ratios for every bank. At 12.42%, Deutsche was at about the 20th percentile. It was very undercapitalized. In fact, to give you a sense of perspective, the typical investment banking / bank, banks with investment banking arms, had regulatory capital ratios of 15.67%. So part of my story is already getting told. Deutsche is a severely undercapitalized bank. But the story is still unfolding. They were losing money, a lot of money, and I expected them to keep losing money for the next 2 years. So remember, those losses are going to make their problems worse. So I told a story for Deutsche. Remember, every valuation is a story. In my story, here's what I see Deutsche doing. I expected to survive and not become an incredibly lucrative bank, but a bank that is going to go back to making at least its cost of equity. So I'm not telling an upbeat story. I'm telling a pretty damaging story, but it's a story of survival and making it back to the point where you will earn the return equity. So over time, here's the first thing I did. I took their return equity, which right now is minus 13.7%. In my story, at least, it recovered to become 9.44% by year 10, which was their cost of equity. So over the next 10 years, I see Deutsche recovering. As it recovers, its losses become profits. So that gives me my net income line. What's the other line I need? I need to know how much they will need to reinvest in regulatory capital. To make that judgment, I'm going to assume that over the next 10 years, to get to a healthy state, they need to bring their tier one capital ratio up from 12.41% to 15.76%. What does that mean? Turn out to? It means that they have to reinvest another $6.6 billion in regulatory capital in year one. So you can see that they'll have to invest hefty amounts in regulatory capital over the next 10 years just to keep going. I'm ready. I take the net income, I subtract out the regulatory capital. So in year one, for instance, I'm expecting a loss of minus 5 billion. I subtract out 6.5 billion. I end up with a free cash flow equity of 11.66 billion minus. So what am I saying Deutsche will have to do in year one? It's a negative free cash flow equity, so they will have to raise fresh equity. Year two, they'll have to raise another 3.7 billion. In fact, for the first 4 years, they will need to raise equity. That shouldn't be a surprise. You have a money-losing bank, you have a tier one capital ratio. Not surprisingly, their cash flows are negative. Year five, finally, they have free cash flows equity that are positive, 2.87 billion. What does that measure? That measures the potential dividend they can pay in year five. And then I build up and the cash flows get more positive. So in my story, the bank recovers, it earns its cost of equity. I discount those cash flows back at the cost of equity. The value per share that I get for Deutsche is about $23 per share. Stock was trading at about $13.33. Now, there's one thing I haven't factored in, which is in October of 2016, Deutsche was in so much trouble that there were rumors floating around that the German government might have to take the bank back into receivership, essentially run it as a government bank. Not permanently, but for a few years. That's what happened to the Royal Bank of Scotland after 2008. That's a nightmare scenario for me as an equity investor, because if that happens, you know what will happen to my equity? It'll get wiped out. So just as I adjusted Las Vegas Sands for the probability of failure, I'm attaching for the probability of failure, which is pretty low because Deutsche is a pretty big bank. The government is not going to do this until things are really dire. There's a 10% chance my equity will be wiped out. My expected value for the shares is $20.67. Stock is trading at $13.33. Yeah, legitimate question is, did I buy? I did. And I got incredibly lucky because over the next year, Deutsche did recover. It did have to issue about $11 billion of new equity in rights issues, which you could see coming given the problems they were in. And I actually sold half of my holding at the time of the rights offering. Unfortunately, I didn't sell the other half. You know why? Because a year after, what did Deutsche do? Find a new basement to go into. A new horror story. And the new horror story drove the price back to 7. This is a company that doesn't seem to be able to get out of its own way. It's a challenging bank to value. It's much easier to value a nice, healthy bank. But in a sense, if you pick a troubled bank to value, it will force you to think about what it is that drives the value of a bank and what it is that you should be more scared about when you invest in a bank. Go ahead, Sriram.
Last semester I did like a bank analysis paper on Citi for one of my classes.
Mm-hmm.
And like, I think Citi is typically considered like maybe one of the poster childs as like one of the better banks, because their capital ratios are good. Like their balance sheet is essentially fine. But the conclusion I came to was that they were basically using their balance sheet as like a way to be a bank, and then they were just doing everything off balance sheet, because they had like, I think like several trillion in derivatives contracts or something like very sort of like alarming.
So you think that truly their regulatory capital is too low given the risks they're exposed to. That's basically what it boils down, right? Because if you're taking it off balance sheet, you're basically doing risky activities that normally you'd have to set regulatory capital aside for, which you're not. So relative to those activities, they have too little in regulatory capital. And if that's your concern when you value Citi, you know what you need to do, right? Take their existing regulatory capital ratio and say, look, I'm going to increase this ratio even though it looks good because you're doing all this risky stuff on this side, which will give you much lower, perhaps more negative free cash flow equity. So By having these levers, you can bring that worry in. Whereas if you did a dividend discount model valuation of Citi, there's no place in that valuation to bring in this concern, right? So this way you can bring in both the good stuff that comes from playing the derivatives intermediary, that you can make more net income, but also the bad stuff, which is if there's additional risk, I'm going to make you invest more in regulatory capital. But the one thing that you then have to do is invest some time learning about regulatory capital. I'll tell you quite honestly, I didn't want to do it. I didn't want to read the Basel Accords and all that crap. It's written by bankers for bankers. But the reality is, if you invest in a bank, you have to learn those details or you're going to get burned.
Thank you.
Incidentally, if you're valuing a fintech company, let's say you're valuing PayPal, Square, or even a younger fintech company, one of the things that I think makes these fintech companies look so attractive is they're able to do the things that banks do without any of the regulatory capital overlay, because the regulators don't even notice them. They're small. What's a big tree? Lending tree goes out and lends money. We're not going to. But you know what? That'll change. As they get bigger, there will be regulatory capital requirements. So when you value a fintech company, you have to bring in that regulatory cost that's going to come into this company as it gets bigger. Doesn't mean it'll be a bad investment, but it does mean that if you don't factor in, you're overvaluing the company. Let's move to any other questions about banks? Because when I talk about financial banks, I know it applies to investment banks, insurance companies. Basically, they're all creatures of the same, without the same problem. You got to think about regulatory risk and how it plays out in terms of investments they have to make. So let's move on. Nick, you have another question?
Yeah, like like would you say that you should value Berk the same way you value banks and insurance companies?
Berkshire Hathaway is just a holding, it's just an insurance company with, and that's why we described it. When I valued Berkshire Hathaway, I said, don't make it fancier than it is. It's a very well-run insurance company, Geico, with the best known portfolio manager of all time running its money until very recently, Buffett. And what's happening at Berkshire Hathaway is as Buffett fades, as he ages, it's starting to look more like a traditional insurance company. So you can value Berkshire Hathaway the same way you'd value State Farm or Allstate or any of the big insurance companies. It's about premiums and payouts and taking the right risk.
Thank you, Professor.
So let's talk about valuing companies with intangible assets. The primary problem with valuing companies with intangible assets is not coming up with the cash flows, the discount rates. The accounting is a mess, right? Think of why. The investments you make to get intangible assets usually take the form of R&D, customer acquisition costs. And what do accountants do with them? Screw it up big time, treat it as operating expenses. So that's why we went through that time of capitalizing R&D. It's not because I like doing that stuff, because if I don't do that, I can't answer these questions. So if you're a software company, what are my cash flows? If I don't capitalize R&D, I give you the wrong answer. When I ask you, what's the value of future growth? If I don't capitalize R&D, I'm going to give you the wrong answer. So let's talk a little bit about the accounting rules and why they create inconsistencies and what happens when you clean up after accountants. So the basic problem is, and this is not just a problem for pharmaceutical and technology companies, is any company that doesn't have traditional CapEx, which is land, building, equipment, factory, right now accountants are all over the place. So if you have pharmaceutical and technology, it's R&D. With consulting firms, it's recruiting expenses. With brand name companies, it could even be advertising. And that's why we talked about capitalizing those expenses and adjusting everything about your company. So I'll give you an example. About 10 years ago, I valued Amgen. You're familiar with Amgen, right? Largest biotech company in the world. It's now more like a pharma company than a biotech company. Lots of R&D. I gave it a 10-year life. Why? Because in the pharmaceutical business, it takes a long time to get from R&D to a commercial product. I capitalized the R&D. And remember how we did that? We basically go back 10 years and we write off. So we keep track of how much you're writing off, 1.694 billion, and what's left of previous year's R&D. And then we adjust all our numbers. And think about the effects it has. In the case of Amgen, the earnings go up because I've capitalized R&D. I've replaced R&D expense with this amortization, so I have higher earnings. That's good, right? But my book equity also goes up, which pushes up my invested capital. So numbers like return on capital and return on equity become lower after I capitalize R&D. But don't forget the end game here. The end game is to value these companies. So I actually valued Amgen with my corrected numbers. I felt that was the right thing to do. So I used my corrected operating income, my corrected return on capital, my corrected reinvestment rate with R&D treated as CapEx, and the value per share that I got for Amgen with the corrected numbers was about 74. Those of you use my spreadsheet, and you know one of the items I ask you is, do you want me to capitalize R&D? If you say yes, and you fill in the lines, I do this for your company. So I do what I did with Amgen. Value I get is 74. Stock was trading at 55. So based on my valuation, Amgen looks cheap, right? So I decided to try a simple what if, right? This is assuming R&D gets capitalized. So I went to my spreadsheet and changed the yes to a no. The minute you do that, you know what I end up doing? I revert back to the original accounting numbers. Do you think my value will be different when I revert back to the original accounting numbers? I hope so. Otherwise, why did I waste my time doing this, right? I'll show you what the value would have been, and you're going to be shocked. If I don't capitalize R&D, if I go with the accounting numbers, the value per share that I get for Amgen is $43. By capitalizing R&D, I almost doubled the value of the company. Do you think this is going to happen every time I capitalize customer acquisition costs, R&D? Will the value always go up when I capitalize things? Andreas, what do you think?
So I would say yes, but I also have a question on when are we supposed to like take that, because sometimes we want to be more conservative and like R&D might not be
See,
important.
I think the
for us.
second answer comes from the first one, because if you believe that capitalizing R&D will always increase value, it should worry you a little, right? Because, so I'll give away a secret. Capitalizing R&D will increase the value of some companies and decrease the value of others. And let's talk about why. At the same time that I valued Amgen, where R&D helped me, I valued Merck, another pharmaceutical company, same 10-year life. You know what happened to Merck's value when I capitalized R&D? It went down 25%. So the question to ask is, what is it that Amgen does differently from Merck that's leading R&D to create value at Amgen but destroy value at Merck? What do you think the answer is, Andreas?
I'm not really sure.
In fact, let's reason it through. What's the value of growth? So if you think in general, it's investing in projects that earn more than your cost of capital, right? So when you invest in things that earn more than your cost of capital, if you do it, your value goes up. So what's Amgen doing?
In buildings that are
their R&D is actually paying off. They're actually getting a return on their R&D that exceeds their cost of capital. The R&D is helping them. You know what Merck was doing in the 10 years leading into that valuation? They were spending billions of dollars in R&D and nothing was happening to earnings. Their R&D was actually destroying value. So it's not a question of conservative or optimistic. When you capitalize R&D, what you're doing is you're forcing the company to be accountable for all this money they're spending in R&D and say, show me it's helping me. R&D, there's no glory in doing R&D for the sake of doing R&D. You're a commercial enterprise. And in this case, you're able to differentiate across firms. I would use the same reasoning with customer acquisition costs. All these ride-sharing companies and the delivery companies, Deliveroo just went public in the UK, all want to capitalize customer acquisition costs. They think if you capitalize customer acquisition costs, their value will go up. And I tell them, be very careful here. If you're spending a lot of money acquiring customers and those customers don't spend much time on your platform and don't spend much money, guess what this is going to do? It's going to lower your value as a company. So capitalizing R&D, capitalizing customer acquisition costs, capitalizing recruitment expenses doesn't help or hurt the company. And the effect and value is going to depend on, do you deliver from that capitalization? So it's a long answer to why did we waste all our time on capitalizing those things, to get a more realistic sense of, should I be rewarding or punishing this company when it spends more money on R&D? So let's talk about one final example before we close the books on intrinsic valuation. Valuing cyclical and commodity companies. I know some of you are valuing oil companies. I think there's one person valuing a gold mining company. And cyclical companies are usually automobile, housing stocks. You think, what's the big deal? When you value a cyclical commodity company, there's always a macro hangover over every question you ask. Let me explain. Let's say you're valuing an oil company. When I ask you, what are your cash flows from existing assets? And you show me last year's numbers. You know what that's going to depend on? Whether oil price were $80 a barrel or $40 a barrel. If they were $80 a barrel, the cash flows are going to be huge. You made a lot of money. If they were $40 a barrel, you probably lost money. When I ask you, what's the value of future growth? If oil price are 80, everything looks good. Every project is earning more than the cost of capital. But if oil price are 40, those exact same projects all look like losers. When I ask you, how risky are you as a company? If oil price are 80, you're doing so well. You have lots of cash flows. You have very little default risk. Your cost of capital is low. But the same company with $40 oil prices is on the verge of default. You see, with every question, there's this macro hangover. And you're going to be tempted, to do what? You value an oil company because you know the oil price drives the value of the company. You're going to be tempted to forecast oil prices. And I'm going to make a plea, and it's going to be a very difficult plea to follow. Please don't. Don't try to forecast oil prices when you're valuing an oil company. Sounds like a strange thing to say, right? But Parker, let's suppose you're valuing an oil company. Do you have a strong view on oil prices? You think they're double, half?
You mean right now?
Yeah. What do you think will happen? They're right now around $60 a barrel. What do you think is going to happen over the next 5 years?
I think they'll go up.
I'll make it stronger. I'll say, let's assume you expect them to double over the next 5 years. Why? Because you think Saudi Arabia is going to go to hell in a handbasket. Oil prices are going to double. Let's say you're valuing ExxonMobil. And you put in the expectation that oil prices are going to double over the next 5 years into your valuation. You know what you're going to find, right? ExxonMobil is going to look cheap today. You're saying, so what? If I asked you, why is ExxonMobil cheap? There are two things that are driving your valuation. One is what you think about the company, and the other is what you think about oil prices, right? In this case, if you think oil prices are going to double, it's going to completely dominate whatever you could have a terrible oil company, it's still going to look cheap. And here's why you don't want to mix what you think about a company and what you think about oil prices. If you're really, really, really good at forecasting oil prices, should you be even valuing ExxonMobil or oil Dutch? It's a far easier way for you to make money, right? If you're really good at forecasting oil prices, what should you be doing to make money of that?
To buy the futures.
Go buy the futures. What the heck are you doing messing with Royal Dutch and ExxonMobil and doing DCFs? You have a gift that'll keep on giving. You want to make your valuations of commodity companies as price neutral as you can make them. It's a lot more work than you think. And I'll use a company that I valued a couple of years ago to kind of illustrate this process. And incidentally, this is one of those places I've talked about Monte Carlo simulations before, where I find Monte Carlo simulations kind of get my anxiety level down. They make me feel more comfortable with the valuation, especially because the variable that I'm most concerned about is commodity prices. It's not who runs ExxonMobil and where they will do their exploration, is what will happen to oil prices. So I'm going to show you a valuation of Royal Dutch. I'll go to page 356 and then I'll come back to 355. So I valued Royal Dutch this was in 2016. I did this for their finance group in Houston and again for their overall management in London. So they said, can you value Royal Dutch? And I said, yeah, boring company, but somebody's got to do it. So here's the first thing I did. I went back and collected the revenues every year going back to 1989. So the columns are my revenues. The brown line is the average oil price each year. These two look like they move together. I mean, this is like in lockstep, right? In fact, you don't believe me, all you need to do is check out the R squared. 96.4% of the variation in revenues over this period can be explained by just oil prices. It's not a company where I'm going to worry about who's the management of the company, what's their return on capital. This is an oil play. If oil prices go up, Royal Dutch is going to do well. If oil prices go down, Royal Dutch is going to do badly. So in March of 2016, I'm going back to the previous page, I decided to value Royal Dutch. At the time that I did this valuation, the oil price was $40 a barrel. It had dropped from $75 in the previous year down to $40 a barrel. And I faced a challenge. Normally, when you value companies and I ask you for your base year numbers, you give me trailing 12-month numbers, right? What happened last year? I looked at those numbers for Royal Dutch and said, I can't use these numbers. And here's why. What did I say the average oil price was over the previous year? $75. The trailing 12-month numbers reflected the $75 oil price. If I just use them as my base numbers and my oil price is now down to 40, I'm going to overvalue the company because I'm building off base numbers that are too high. So I faced a challenge. I needed to forecast what the revenues and earnings would be for this company if the oil price were 40. Saying, how the heck are you going to do that? If you go to the next page and you see this chart, I actually ran a regression of Royal Dutch revenues against the average oil price. Basic statistics. You say, how do I read that regression? Every $1 increase in price per barrel of oil adds about $4.04 billion to Royal Dutch's revenues. You tell me the oil price, I'll tell you what the revenue should be. In fact, if you go back to the previous page, that's exactly what I did. I took the $40 oil price, plugged into the regression, I got predicted revenues of $201.6 billion. That's actually $15 billion lower than the trailing 12-month revenues. But if you want to be oil price neutral, you actually have to do this, because if you don't do it, you're building in expectations of a much higher oil price into your base year numbers. Now, the rest of the valuation was pretty straightforward because I just projected margins and growth. So basically, it looks like any other valuation, but that trailing 12-month number was the number that was the biggest fix. With that fix, the value per share that I got was about $39 per share. The stock was trading at about $42. So I present this valuation. I think it was in Houston. And one of the people in the finance group puts up his hand and says, what will happen to that value if oil price goes up? This is like one of those slam dunk questions. You know the answer is, right? The oil price goes up, so the value will go up. And then he says, should I worry about the fact that oil price can change? And I said, worrying can lead you to a better decision. By all means, worry. But what's worrying going to do for you other than give you an answer? He said, is there a way in which we can bring the uncertainty about oil prices into a valuation? And I said, yes. But it requires that you move past traditional discounted cash flow valuation. So here's what I did. I took Crystal Ball, that program you add on to Excel, to my Royal Dutch valuation. What's the number I'm most uncertain about? The oil price, right? Right now it's 40, but I'm concerned it could be 60, it could be 30. So I put in a distribution for the oil price. You're saying, where the heck did you get it? It's easy, oil's traded. I can come up with the distribution. I put in that distribution. So here's how the simulation works. The computer goes and picks an oil price out of that distribution. Let's say on the first run, it picks $52 a barrel. I estimate the revenues based on the regression. With $52 a barrel, I get high revenues. I get operating income, cash flows, I value the company. Then the computer goes and picks a second price, $35 a barrel. I revalue the company, and I do it over and over and over again. In fact, with Crystal Ball, the default is 10,000 simulation. It takes it about a minute to run. And the output is a distribution of values per share for Royal Dutch. So instead of giving you one number, $39.31, I now give you a distribution saying, what the heck am I supposed to do with this distribution? What did I say the stock price was? About 42, right? So if you ask me, what do I think about the stock? I'm going to say it's overvalued. You're saying, well, you could have told me that with your base case. That's true, but I can be more specific here. I think there's about a 65% chance the stock is overvalued and a 35% chance it's undervalued. You know how I came up with the 65%? Look at this distribution right here. The 50th percentile is 37. The 60th percentile is 40. The 70th percentile is 44. Basically, 42 falls right there between. So it's about 65% of my simulations, I got a value lower than 42. In 35%, I got a value higher. Now do you see why it's so much richer to have a distribution rather than a single number? Imagine being a portfolio manager. You ask me to evaluate 50 stocks and they're just telling you which ones are undervalued and which ones are overvalued. I tell you these percentages. I give you the distributions. I sent you the link to Crystal Ball, which you can get. I mean, Stern has a free version. Use it while you're at Stern. You can just run it. But if you want to get it permanently, it's an Oracle product. You can download a trial version. It's a few $100s, but there's a student discount. And that student discount obviously works only as long as you're a student. So if you can afford it, it's better to buy it as a student and keep it, because you wait, it's going to cost you 4 times as much. But it'll turn any valuation you have into a simulation. Patrick?
Isn't the whole purpose of the really large derivatives books that these commodity companies have to mitigate the change in cash flows?
No, in fact, that's exact opposite. You should not be, ever. As a commodity company, you should never be hedging your output risk. And here's why. Why, we talked about Royal Dutch, right? Why does somebody buy Royal Dutch shares? It's not because they love the management. It's not the fact that they like the Netherlands or the UK. They buy it because they think oil prices are going to go up. It's an oil price play. Let's say Royal Dutch now goes and hedges oil price risk. You know what that means, right? You buy the futures contracts, you lock in the price. Let's say oil prices double. What's Royal Dutch going to report next year? They're not going to report a doubling of revenues. They've locked in their revenues based on existing prices. They've undercut the only reason I ever invest in oil companies, which is I'm making a bet on oil prices. So the rule on derivatives is you don't do it. You know who should be buying oil futures, right? It's not the oil companies. It's the companies for whom oil is a cost. Airlines hedge against oil price risk makes sense, right? And that's the point of derivatives books. It's not for output companies to hedge their risk. It's for input companies. So if you're a sugar producer, I don't want you to hedge sugar price risk. But if you're Hershey's and sugar is an input, I want you to hedge the risk. So with oil companies, you will notice that most of them don't hedge, and those that hedge get punished by markets for hedging, because investors get disappointed very quickly. So they let that risk flow through. That's why investors like these companies. Any other questions? So now let's close the deal. We've talked a lot about intrinsic value, and by now, no matter which model you use, you can see what drives intrinsic value. It's cash flows, growth, and risk. You can use discounted cash flow models. You can use accounting models, but ultimately you're trying to value a company based on its business model. I'm going to open the door to the other way you could put a number on your company, which is pricing. Pricing is driven by demand and supply. It's driven by mood and momentum. And the kinds of tools we're going to bring in to price something are very different from the tools you bring in to value the same thing. So the value process yields value, the pricing process yields price. In fact, let's call the difference between value and price the gap, not the store, but this is the gap between value and price. I'm going to argue that every single investment philosophy you see out there is based on some view of what that gap is and what causes it to close. I'll be more explicit in a moment. But let's lay the foundations for the difference between pricing and valuation. The best example, and I gave this very early in this class, so thinking about pricing is think about how much you pay for a house or an apartment. You go on Zillow or you go on Redfin, you find an apartment in New York City that you plan to buy, or a house in wherever suburban New Jersey you want to buy. It always comes with a price, right? It says, gives you pictures of the house, and it's a price of the house, $500,000, $1 million, $1 million. Think about how that number, people come up with that number. You want to sell your house. How does the realtor come up with a number? They look at other houses in the neighborhood, look at what they sold for, adjust for the fact that you have an extra bedroom or a bigger backyard. It's pricing. In fact, real estate is almost entirely a pricing game, even commercial real estate. Before you say those unsophisticated realtors, remember, typical sell-side equity research report is not a valuation, it's a pricing. And here's what I mean. When you pick up a sell-side equity research report, you see a buy or a sell, here's what it's based on. The PE ratio for this company is 15. These 15 other companies are just like your company. They trade at 20 times earnings. 15 is lower than 20, therefore it's cheap. So pricing is a very different process. You're not asking about cash flows, growth, and risk and discounting them. You're looking to see what other people are paying for similar assets. So earlier when we talked about intrinsic valuation, I said to do an intrinsic valuation of a company, you got to ask questions about business models. What are the cash flows from existing assets? What's the value of growth? How risky are you? When will you be a mature company? And that's what we tried to do in discounted cash flow valuation. You're saying, what drives price? I hate to say this, but the biggest force driving price is mood and momentum. I mean, take a look at GameStop. On any given day, why is the stock up 50% or down 30%? It's the mood on that day. It's momentum. Somebody earlier, I think, mentioned about Credit Suisse and the losses it's facing. One of the things that's happening is this is actually a Chinese family fund with billions of dollars to invest that had made these hugely levered bets across the world on stocks. And now it turns out they're in trouble. So the banks are trying to liquidate their holdings. Viacom was down 20% in the last couple of weeks. You think, what happened to the value? Value didn't change, but what happened was the liquidity changed, right? There was a lot of selling, it pushed down the price. Pricing is driven by mood, it's driven by liquidity, it's driven by herd mentality. People move in groups, right? And I'm not just talking about Wall Street bets. I'm talking about the fact that traders generally move together. And finally, on the small piece of information, look at it and say, really, that made the price move that much? The pricing process is very different from the value process. Andreas?
But wouldn't we we don't really need to care about that, because if we're holding a stock, for example, in the long term, we would expect that any corrections with their estimates
that's
or
the fate. What's a guarantee that it'll happen?
Well,
Right?
not really.
It's fate. I agree with you. And in fact, one of the things I'm going to talk about is maybe the longer, and that's what we've been sold. If you have a long time horizon, you don't have to worry about the crazy market. It'll always come back to value. And I'm going to raise the question of, what if it doesn't? What if you waited 10 years and the correction never comes? There's no brownie points here, right? You either make money or you don't. So when you think about the gap, there are three different views you can take of the gap. You know what the gap I'm talking about, right? Price versus value. There are some people who look at it and say, what gap? Why? Because they believe in efficient markets. What's the essence of an efficient market? The price and the value of different processes, but they tend to converge very quickly. It's not even over time, it's right away. So in an efficient market, there is no gap. But let's take a trip to Omaha, Nebraska. Every year you got the Berkshire Hathaway meetings. And of course you have people that I call value extremists. And the reason I use extremists is they believe value is the only thing that matters. And the price is going to come back to value. It's a given. To them, it's the faith. It's not even faith. It's dogma. The price will always get back to value. Why do I care about traders? Traders are shallow. They're crazy, but they're going to have this accounting. One of my favorite shows on CNBC to be on is the show that comes on right after the market closes. It's called Fast Money. And it's 5 traders. And I really enjoy being on that show because they have absolutely no, they don't care about value. They tell you to your face, who the heck cares about value? You make money by buying at a low price, selling at a high price. And I prefer that honesty. Because their view is, value is this abstraction. You can talk about it, but I make money by buying at a low price. And if I do it on momentum, so what? And I'm going to argue that each of these views comes with its own weaknesses. So if you're in any of these camps, I want you to think about what the potential things that can go wrong. If you're a pure trader, here are the troubles you face. First is you have no anchor, right? Basically, there's no fair value around it. If I ask you what's the right price for Tesla, your response is whatever the market thinks it is. And that makes you reactive, right? There's nothing you can target. So you constantly are looking over your shoulder saying, what are other people thinking? Because that's how you make money. Traders are constantly watching other traders because there is no true value that they can target. And if you're not careful, those same crowds that helped you make money can turn on you. Right? You making money because you joined the crowd, but what if they decide to go in the other direction? So good traders are good at detecting shifts in mood, shifts in momentum, and getting out before it happens. But if you believe in intrinsic value, you have your own set of dilemmas, right? The first one is when you tell me something is undervalued, you say, are you sure? Your answer is, I think so. I mean, think about your own valuation. If I said, are you sure about this value? Would any of you say, I'm sure? I couldn't value a company. I said, this is what I think the value is, but I made a lot of assumptions about growth and margins and reinvestment. So you feel uncertain about your own value number. And over time, value investors have devised their own ways of dealing with uncertainty. Some old-time value investors use what's called margin of safety. Have you heard of this? Basically, it says, I don't buy stocks when they're undervalued. They have to be undervalued by at least 20%, at least 25%. Some think the answer to uncertainty is to go out and collect more information. In my view, uncertainty never decreases when you go out and collect more information. You just get more uncertain. Now, with Excel spreadsheets, you can ask all kinds of what if questions. What if revenue growth is different? What if so you can ask all kinds of what if questions if it makes you feel better. And finally, you can actually use these simulations to actually face up to uncertainty and bring it into your analysis. So if your primary problem is you feel uncertain about value, I can give you some tools to deal with that. But there's another problem, which I think is a much more serious one, which is, hey, we can get over the uncertainty we feel about value, but to make money, the price has to converge on value. That was Andreas's point, is that gap has to close. And one way we've been told you can get that problem under control is by having a longer time horizon, right? Because then if you wait long enough, the gap will close. But that could take 25 years. The gap can outlast you. What is it that Keynes said? The market can stay rational longer than you can stay solvent. Or wouldn't it be nice if you can create the catalyst that somehow makes the gap close? In fact, when you have a gap between price and value, and you're an investor, you can take two views. One is what I call the karmic view, which is the gap is there, nothing I can do about it. It's going to close or not close. Worrying about it is not going to do much, which is what old-time value investing told you to do. Don't worry about it. It'll close on its own. But what if you could trigger that closure? I mean, if you watch a Carl Icahn or a Bill Ackman, what they do after they buy a stock is they don't sit quiet. They tell the world they've done it, and they hope by telling the world they can make, that's a catalyst. They're providing their own catalyst. And you saw this with GameStop, right? What's the name of that guy last year who started this GameStop craze? What was his handle? Crazy Rooster, something. It was, he had a name on Wall Street Bets. He was the first one to do value GameStop. He actually used a social media platform as his catalyst, right? Because he kept posting and posting and posting, and then people latched on, and before you knew it, it actually raises an interesting point. Maybe we don't need to be as wealthy as Bill Ackman or Carl Icahn. You just need to have a lot of followers. Have you noticed all these SPACs are signing up celebrities? In fact, I think there's this Sacramento-based SPAC that is targeting WeWork. And as I was reading who was in the SPAC, they gave the names of these private equity investors. And they said, our advisor is Shaquille O'Neal. They said, what? What kind of real estate? But you can see why, because if Shaquille, I think Shaquille, when I checked, has like 5 million followers. There's actually a rhyme to why people are signing up Colin Kaepernick and Shaquille O'Neal, and I think a couple of big basketball. I'm surprised LeBron's not there yet, right? Because you sign up LeBron James and he says, go buy the stock. There would be people who just buy the stock, no questions asked. It's a catalyst right there. Catalysts are what make you money. So just to illustrate how this delicate dance between price and value plays out, I'm going to show you my valuations of Apple going back almost 10 years. Apple's a company I valued every year and I have to tell you up front, it's a company I love. So factor that in when you look at what I've come up with as value. I value Apple every September. Why every September? Because I feel like valuing it in September. Don't ask me why fall's coming and I think this is the time to value Apple. But it gives me this So September of 2011, when I valued Apple, I came up with a value of 69. The stock was trading at 54. I already owned Apple, so I was happy. It stayed in my portfolio. 1 year later, I valued Apple. It's pretty close to fair value. It stayed in my. So if you look at this last column, you can see the stock goes from being undervalued to overvalued to undervalued to overvalued. The reason is very simple. I think I mentioned that the story I've told for Apple is pretty much the same for the last decade. But the market seems to react to Apple in a manic, depressive way. So, and it usually revolves around a new iPhone. A new iPhone model comes out. If it does better than expected, people say, oh my God, Apple's back to being a growth company. We're going to put in a 20% growth. They push up the price. A next iPhone model comes out, or it doesn't do very well. They say, this is the end. Apple's done. I'm selling everything. So you see these swings. And we said mood and momentum in Apple swing. And you know what? I've bought Apple 5 times in the last 10 years. I've sold Apple. I sold Apple for the last time in September 2020. But you can see why people look at the swing and say, that's frustrating. To me, this is the basis for investing, is markets, price. You and I, if we're investors, value. Both the value and the price change, but the price will change more because it's driven by mood and momentum. So the same stock can go from being undervalued to overvalued. I'm going to close the intrinsic value section with snapshot from one of my favorite movies. It's The Wizard of Oz. You've seen the movie, right? I'll summarize what the movie is, and you're not going to like the story. You're going to say, that's so unrealistic. Hey, you watch Game of Thrones. You thought that was realistic? So in The Wizard of Oz, there's this girl called Dorothy who lives in Kansas. And a tornado sucks her up out of Kansas. I didn't write the story. Somebody came up with the story and it passed muster. Took her and dropped her into the land of Oz. And she lands on top of this witch. I keep forgetting which way, witch from the west or witch from the east. But when she lands on the witch, she kills the witch. So she's facing homicide charges, I guess. So the movie starts with this happening. Dorothy lands on the witch is dead. Now Dorothy wants to get back to Kansas. So she turns to this munchkin on the side of the road and she says, how do I get to Kansas? The munchkin says, why are you asking me? I don't even know where Kansas is. Why don't you go ask the Wizard of Oz? He has the answer to every question. And she says, how do I get to the Wizard of Oz? And the munchkin says, follow the yellow brick road. And for the next 3 hours, it's a really long movie, Dorothy hops and she skips and she runs. She never walks. If you watch the movie, you'll see what I mean. Down the yellow brick road, trying to get to the Wizard of Oz. And along the way, she collects a motley crew. A lion that needs courage, a scarecrow that needs a heart, a tin man who needs so each one needs something. And they're all told, go see the Wizard of Oz. And they finally get, so about 2 hours and 50 minutes into the movie, they get to the Wizard of Oz's chambers. And the wizard is behind a curtain. And they all tell the wizard, this is, great wizard, we've come for your help. I need to get to Kansas. I need a heart. I need courage. And the wizard says, come back tomorrow. It's like DMV, right? You get to the top of the line and the DMV guy says, come back tomorrow. They say, we come all this way. And then the curtain drops and they realize there's no wizard. There's this guy behind pulling rods. And it turns out that there's really no Wizard of Oz. But the big story in the movies, each of them got what they wanted on the journey. Dorothy found these red shoes and she clicked them. She was back in Kansas. The lion fought off some bad guys and got courage. But the point is, they got what they wanted on the journey. You say, what's this got to do with intrinsic valuation? What is an intrinsic valuation? There are all these questions you keep running into. Do I use an effective tax rate or marginal tax rate? Can my sales to capital ratio change over time? And you keep thinking there must be a Wizard of Oz out there that I can go ask this question. And what I'm trying to tell you is there is no Wizard of Oz. The answers to every intrinsic value question lie in doing intrinsic valuation. Don't Google search. What tax rate should I use? Reason it through. It's something I've tried to put in with the valuation of the week, where you can at least see me struggling with these inputs, because by struggling is how you get the answers you need for this process. So I know we're getting to the end of the class. Let me at least get the next section started, because we're going to talk about pricing for much of what we're going to do next. So let's think about the difference between, I'm sorry, I hit the wrong button there, between pricing and valuation. So the essence of pricing is very simple. What you're trying to do is essentially put a number on an asset based on what similar assets are trading for. I think I might have given this analogy before, but I'm going to give it to you again. It's almost baseball season. Now, when is the Yankee opening day? Is like a week from now, maybe it's very close. Let's say you want to go to opening day. I heard they're allowing, what, 8,000, 10,000 fans, something like that. You try to buy a ticket through Yankees.com, but they say it's sold out. So what do? You go to StubHub and you pick a section and you want to buy a seat. How do you decide how much to pay? Well, the nice thing about StubHub is they tell you the prices that people are charging for all of the seats in that section, 120, 133, 115. So if you paid 400, you're clearly overpaying. If you get it for 60, you're getting a bargain. That's pricing. You're looking at similar assets and coming up with a number. The essence of pricing is there are 3 steps. First is you want to find other assets just like yours. In this case, other seats in the same section. You want to make sure the prices are comparable. And with seats, they're all similarly priced. But if you're buying real estate, for instance, you can't compare the price of a 10-story building to a 5-story building because one is twice as large. So what do? Look at price per square foot. In the context of stocks, you divide price by earnings, price by book value. Basically, any time you use a multiple, you're essentially looking at a standardized price. And then you control for differences. Every pricing has those 3 steps. Coming up with companies that you think are similar, standardizing price, controlling for differences. But I'm going to start with a statement and I'll back this up. Much of what passes for valuation out there on Wall Street and M&A and equity research is really pricing. And let me back that up. About 20 years ago, I collected about 550 equity research reports from around the world. And I'll confess, I didn't read most of them. I collected them because I wanted to see how analysts put numbers on companies. How do they come up with the buy and the sell recommendations? Out of the 550 equity research reports, 45, less than 10% were based on DCFs. You know what the rest of the equity research reports were based on? The buy and the sell. They're based on a multiple, P/E, EV to EBITDA, and a bunch of comparables, a peer group. 85 to 90% of sell-side equity research is pricing. If you don't believe me, walk into any investment bank, look at those bank of equity research reports, pick up 20 of them, read through them, they'll all be pricing. I said, maybe it's different in M&A. I was able to get my hands on about 100 acquisition valuations, and there it's split down the middle. About half look like DCFs. I said look like, but then I took a closer look. And the biggest number in each of these DCFs is the terminal value. And guess how most of them got a terminal value? Using 6 times EBITDA or 10 times earnings. They were pricing in drag. So I was a little surprised, and here's why. Now, early in this class, I put a question to you, and I said, you don't have to answer the question now, but I'm going to show it in the very last class. And I'll give you a preview. By the end of this class, hopefully you'd have done an intrinsic valuation of your company, you'd have done a pricing of your company. In the last class, I'm going to ask you, given your experience in valuation and pricing, if you had to pick one of these 2, which one would you pick? And in the 35 years I've been teaching this class, it's always broken down about 70, 20, 10. 70% of the people when they leave my class tell me that they want to do intrinsic valuation, reflecting my biases. About 20% say pricing is so much easier, more direct. I prefer using a PE ratio. And about 10% become believers in efficient markets after they've tried valuing and pricing a company, saying this was much more difficult than I thought. Maybe the market's not as stupid as I thought it was. But when they leave my room, 7 to 2 people believe in intrinsic value over pricing. I haven't done a follow-up on this, but I'll wager if I track these people down 5 years later, in whatever jobs they have as analysts, bankers, that the numbers get switched. Something seems to happen between the time people leave my class and when they start working that makes them go from being true believers in intrinsic valuation to pricers. So as the last thing that I want to do today, I want to talk a little bit about why people end up in pricing. The first reason came to me while I was watching a Seinfeld episode. You've seen Seinfeld, right? Quintessential New York sitcom. This episode, one of Jerry's girlfriends accuses him of being crazy. He said, Jerry, you're crazy. And his response is, if you think I'm crazy, you should see the guy who lives across the hall from me. You know who lives across the hall from Jerry? Come on, you guys have watched Seinfeld. It's Kramer. And have you ever seen Kramer, or, at least in the show? I mean, he's about as crazy as you can get. So relative to Kramer, everybody looks sane. You think, what's this got to do with pricing? We forget how much of pricing is selling. You're trying to sell me a stock that's trading at 10 times revenues. And I said, that sounds expensive. You know how you convince me it's cheap? You show me 2 other stocks that traded 50 times revenues. Relative to those stocks, it's cheap. It's easier to sell something with the pricing. It's also easier to defend the pricing than it is to defend an intrinsic valuation. Think of why. When you do an intrinsic valuation of a company, all of your inputs are out there for people to pick apart. They don't like your beta, your risk premium, your risk-free rate, your cash flows, your growth rates, everything is out there. Whereas in contrast, when you tell me to put a number on a company based on 6 times EBITDA, because that's what other companies in the sector trade at. Think of the target I've given you. It's tiny, right? You don't like 6 times EBITDA? My response is take it up with the market. It's not my fault. I'm just the messenger. There's a reason why bankers use pricing when they do roadshows for IPOs, never a discounted cash flow valuation. And finally, and this is, I think, the final point I want to make, is I think you're going to be wrong with both intrinsic valuation and pricing. And I firmly believe that you're less likely to be wrong with intrinsic valuation and pricing, but by only a slight margin. You might be wrong 40% of the time with intrinsic valuation and 45% of the time with pricing. You think 40 is better than 45, you're right. But here's the catch. In intrinsic valuation, when you're wrong, you're far more likely to be wrong alone. And here's why. The nature of intrinsic valuation is you're often buying a stock that everybody else is running away from. You're a contrarian. You're selling a stock when everybody else is buying. You think, so what? You know what happens to people who are wrong alone? They lose their jobs. Survival alone will drive you towards pricing, because then if you're wrong, you always have lots of company. I call this the market imperative, which is you're driven by what the rest of the world is doing. You're never judged. It's like having an absolute grade versus a relative grade. You get a 7 on a quiz, that's terrible, right? Until I tell you that the average score of the quiz was 3. The nature of pricing is you're always measuring yourself up against the market, and a lot of your jobs, that's what you're required to do, is pricing. So next session, when we start off, I'm not going to try to talk you out of pricing, because that might be a job. We're going to talk about how to do pricing well. What are things we can bring in that will make us better pricers? So I'm going to stop with that. And as I said, you have until Sunday to turn in your DCF. So take the extra 2 days if you need to, and get them into me.
Thank you.
Thank you, Professor. Can I ask a question?
Thank you.
Professor, can I ask a question?
Go ahead.
It's very quick. Like what like VM or like parallel desktop, because like you have a Mac, right?
Right.
Yeah, like I also have a Mac, and like my VM I use like virtual machine, and like
Why do you need to use a PC version of Excel? What is it you're trying to do?
Yeah, I'm trying to like use Oracle and the capital IP plugin.
Here's the advantage. If you go through the Stern version of Crystal Ball, it actually runs in this program called Citrix, which is an online PC emulator.
Yeah, okay.
It actually has, so basically what you can do is you run Citrix. Excel is already in Citrix. Stern has had it loaded on. So if you use the Stern version of Crystal Ball, you don't need an emulator. If you want to run it on your Mac long term, I use parallel desktop. It's a pain in the neck. I hate doing it. I hate going back and forth. No, but I think that's you have to use some. And with the M1 chip, I don't know what's going to happen, because with the M1 chip, you might have to rethink how we do things, because it's going to be a little different. But it is a pain in the neck. It's I know I've written to Oracle multiple times, but their view is the Mac market is not big enough for them to do a Mac version. I've been looking for a simulation emulator on a Mac. If I find it, I'll let you know. There are a couple that are coming out.
Yeah, I use VirtualBox, but
it's still a pain. No matter what you do, it is still a pain in the neck. It slows everything down.
Exactly. Yeah. Thank you, Professor. So I'm gonna try Citrix then, right?
Yeah.
Okay. Thank you.
So just go into go to Stern links, and it's one of the little boxes. I think it's called NYU apps. You click on it, you see Crystal Ball. Click Crystal Ball, and it'll actually run. It's actually very neat. It runs right in your Mac as kind of a emulation, PC version.
Yeah.
You're welcome.
Professor.
Jacob, yeah, go
I
ahead.
sent,
Okay,
hi.
Uli, go
Yeah, I
ahead.
sent you an email. I sent you an email with my question, but I just want to ask you here.
Sure.
So I'm valuing Square, and they
Yeah.
have a pretty substantial holding in Bitcoin, and
Now,
that has
tell me
gone
again,
up
you said,
in the
no,
past.
but when you say big holding, they're making money of people transacting Bitcoin? Because as far as I know, Square doesn't hold Bitcoin as an investment. They make money on as an intermediary. So when you say hold
They do
Bitcoin,
both.
where is,
So
but how much Bitcoin, but the holding of Bitcoin, is it to help them as an intermediary? It's not like Tesla. There are only two companies that I know of that actually hold Bitcoin like they do cash. One is Tesla, and the other is Micro, whatever. It's a little software company. No other company, no legitimate company that I know of actually holds Bitcoin as an asset. And if Square is holding it, it's probably to kind of facilitate the money they make on Bitcoin transactions, right? So it's a very different game. It's an intermediary game where you make money every time people transact, and it provides a transaction, a place where the transaction can happen. So what you see as Bitcoin in the balance sheet might just be transient. It might reflect the fact that they're acting as an intermediary.
okay.
How big is it? Anyway,
Right.
what portion of their revenues actually come from this Bitcoin business?
Over half.
That can't be right.
So
That definitely
over
can't be right. That definitely can't
what?
even be close to the truth. You're telling me Square's revenues, half of it comes from Bitcoin related business? That can't be true. There's something wrong there. Send me the page where you're basing this. I'll take a look, because I've been tracking Square a long time, and that just strikes me as, it's not that big a player
Okay.
in the Bitcoin business. So something is off here. So I want to see what it is. No. So if you get a chance, send me where you're getting that, because otherwise you're going to go off on this rabbit hole. If Bitcoin becomes the key driver, you'll never get out of that hole. So send me what led you to that conclusion. I'll take a look. Okay.
Okay. All right. Thank you, Professor.
You're welcome. Jacob?
Oh, I said thank you, Professor.
Okay. Oh, that was your question about the Bitcoin? Okay. Uli, you have a question?
Yeah, Professor,
Yeah.
I was just wondering, based on our discussion near the end of class, do you think that the price-based approach taken by investment banks, either the equity research division or investment banking division, negatively affect either the efficiency or the quality of their services?
Well, it depends on what you mean by services. If you're an acquiring company, you want to get a transaction done, how do you define success? Getting the transaction done. Bank is going to help you do that. If you define it as getting the transaction done at the right price, then you got to be careful, because bankers get paid on transactions getting done. It's not the banker's fault. I blame the CFO of a company. If you ask the banker, should I do this deal, you're missing the conflict of interest. So I think trusting bankers to tell you what to do is, I think, extremely dangerous, because they want the transaction to go through. It's like asking a realtor, should I buy this house? Of course, the realtor wants you to buy the house. That's how she gets a 6% commission. But you're going to live in that house. And I think of acquisitions the same way. The banker is there to help you get the deal done. You should be asking the banker for advice on the deal, because they have it's not because they're bad people. Again, it's because their incentive structure is very different.
Right. If they employ more intrinsic valuation, would you think that the quality of the advice would be better?
The quality of the advice would be better, but do you remember the old Jack Nicholson movie where he says, you don't want to learn the truth? There are a lot of acquirers who want to get the deal done at any price. They're spending shareholders' money. So if you gave them honest advice and you told them not to do the deal, you know what many of them are going to do? They're going to walk down the street to the next investment banker, and then the next one, to the next one, till they find one that tells them they can do the deal. So this isn't even, I think, a process where people are interested in doing the right thing, because it goes back to corporate governance at companies. You're spending other people's money, you want to build an empire, you're willing to overpay to build that empire. You want bankers who kind of grease the skids. You can't blame the bankers after it. So you got to go back to the source and say, if you had companies run by managers who really cared about shareholder wealth, then I think bankers would be more interested in intrinsic value. And I would then tie the way I pay bankers, not to whether the deal gets done, but whether the deal is a good deal. Right now, we don't do that, right?
Yeah.
We pay bankers based on whether the deal gets done. So the whole structure, in a sense, has to change.
Right. That makes sense. Thank you.
Wait, hey, professor.
Yes.
Quick question. So, during class, you said that you talk to those traders from that show, and they trade fully off like pricing. So I wanted to ask if like they share their insights of their strategy on how they enter and exit, and if so, can you?
That's why CNBC hires them. Watch at 5 o'clock. Watch Fast Money. They'll tell you I bought Uber because the trading volume went up in the last week. I bought Uber because so that's how they make their living. They're actually pretty open about it. Now it doesn't always work in terms of making you money, but that's what they do on the show.
Well, but for you, since you've been there and you talked to them, they never revealed any other insights that they wouldn't.
There's really no insights in trading, right? It's like trading is about instinct and mood and momentum. There's really no deep thought that involves. So they don't give you the secret sauce. Mm-hmm. They just say, look, I'm like a gambler. I get in at the right time. I get out at the right time. So if you asked a gambler, why did you fold your cards and take your chips at 11 o'clock? He's a good gambler. He said, I knew the moment was right, that if I stayed longer, I'd end up losing the money. That's what traders do. They have that instinct. And if you ask them for an intellectual explanation, they can't give it. It's just, that's what good traders do, is they sense shifts in mood. Now, they might use things like volume and price to gauge when those shifts are coming, but that's what they try to do. Okay. It's actually fascinating because it's very much, you like watching those online poker shows where sometimes you see them on ESPN where you see high stakes poker being played in Vegas. It's like these poker tournaments. Trading is very much like that. It's really about, instinct, knowing when to fold, and Kenny, whatever his name, Kenny Rogers' song, or know when to hold them, know when to fold them. That's very much at the core of being a very successful trader.
Okay. All right. Thank you.
You're welcome.
Have a nice